ITC Limited is one of India's most widely held large-cap stocks. Some investors love it for its strong dividends and stability, while others dislike it for its slow price movement. However, recently ITC shocked the market with a sharp decline, triggering fresh concerns among investors and raising an important question. Is this just a temporary correction or something more serious? Investors who are holding ITC are under serious pressure. What should they do at this stage? How much further can ITC fall from here? And most importantly, from which level can we realistically expect a rebound? To understand the answers clearly, listen to this video till the very end. First, let us talk about the biggest challenge facing ITC right now. From February onwards, the Indian government is increasing the GST rate on cigarettes from 28% to 40%. Along with this, a new excise duty has been introduced, ranging from 2,000 to 8,500 rupees, depending on the cigarette category. When we combine GST and the new excise duty, the final market price of cigarettes could rise by nearly 20 to 25%. This is a major change, and it directly impacts ITC's most profitable business. Why is this important? Because cigarettes contribute around 40% of ITC's total revenue, and more importantly, nearly 70% of its operating profit comes from this single segment. Due to this sharp increase in taxes, most market experts believe that ITC's overall earnings could decline by around 10 to 15% in the near term. In my opinion, ITC is unlikely to pass the entire tax burden on to consumers. If the company increases prices too aggressively, cigarette volumes could fall. So ITC may choose to absorb part of the tax increase, which would put temporary pressure on profit margins. Now let us look at the reality from a market perspective. Yes, earnings may decline by 10 to 15%, but the market stock is already pricing in a much larger negative impact. In other words, the stock has already corrected more than what the earnings impact justifies. There is another very important factor that the market is currently ignoring. ITC today is not the same company it was a decade ago. Over the last few years, ITC has successfully diversified its business into FMCG, hotels, paperboards, packaging, and agribusiness. These segments are gradually becoming stronger and more stable contributors to overall profits. ITC is also known for its strong balance sheet, high cash flows, and consistent dividend payouts, which provide downside support to the stock. So, what does all this mean for investors? While short-term volatility may continue due to tax concerns, ITC has the financial strength, business diversification, and pricing power to recover over time. That is why I believe ITC is likely to stabilize first and then rebound. In this video, we now break down ITC Limited from its business model, financial performance, valuation, and technical perspective. And most importantly, we answer one decisive question: from which exact level can this stock realistically rebound? Is ITC a value trap or a long-term wealth creator in the making? Let's begin. In financial year 25, ITC reported total revenue of 81,613 crore rupees. The largest share came from FMCG, cigarettes, which accounted for 40 to 42% of total revenue. Despite regulatory pressures and higher taxation, cigarettes remain ITC's most profitable segment, generating strong and predictable cash flows that fund investments across other businesses. ITC's FMCG non-cigarette segment contributed 25% of revenue, underscoring the growing importance of ITC's consumer brand portfolio. Staples and packaged food brands such as Ashirwad, Sunfeast, Bingo, Yippee, and Classmate continue to gain market share. However, margins in this segment still remain below those of cigarettes, making profitability improvement a key focus area. ITC's agribusiness, which contributed 22% of revenue, is a scale-driven operation closely linked to commodity prices and global export demand. While this segment adds significant top-line growth and strengthens ITC's rural sourcing network, earnings volatility remains a structural characteristic. The paperboards, paper, and packaging business accounted for 9.6% of revenue. Although smaller in size, this segment plays a strategic role, supporting FMCG distribution, agri-exports, and providing some insulation against input cost fluctuations. The remaining 4% of revenue came from other businesses, including information technology and residual operations. While not material in size, this segment contributes to operational integration and support services across the group. From an investor's perspective, ITC's financial year 25 revenue mix highlights a clear and important trend. The company's dependence on cigarettes is gradually declining, even as the segment continues to dominate overall profitability. FMCG and agribusinesses are becoming increasingly meaningful in scale, although margin expansion remains a work in progress. Overall, ITC represents a blend of stability and transition, anchored by a high cash-generating core business while steadily building a broader consumer and agri-led growth platform. For long-term investors, ITC's evolving revenue structure reinforces its position as a defensive stock, with the potential for steady, long-term compounding.
At this stage, understanding ITC's valuation is extremely important. If we clearly understand the valuation, we can judge whether holding this stock in our portfolio is logically and fundamentally justified. We have estimated ITC's intrinsic value using multiple valuation methods. First, sum of parts valuation, approximately 328 rupees per share. Second, relative FMCG style valuation, up to 440 rupees per share. Third, discounted cash flow model valuation, approximately 270 rupees per share. Fourth, dividend discount model intrinsic value, approximately 303 rupees per share. Now, if we calculate the median valuation, we arrive at an intrinsic value of around 335 rupees per share. Under a base case scenario, if ITC's earnings decline by 10 to 15%, the valuation could be impacted by roughly 30 to 40 rupees per share. Accordingly, under the base case scenario, ITC's fair valuation range would be around 290 to 300 rupees per share. In an optimistic scenario, the valuation potential could be in the range of 330 to 400 rupees per share. Now let us look at ITC from a technical perspective. ITC is currently receiving trend-based support around 340 rupees. If this support level is respected, the stock is likely to rebound from the 340 zone. However, if this support fails, ITC could move towards its next strong support level, which lies at the 50% Fibonacci retracement zone around 310 to 313 rupees. The 300 to 310 rupee zone would be considered a good entry range for ITC. For the current week, investors should closely observe whether ITC manages to rebound from the 340 level. If the stock shows strength at this level, partial entries may be considered. And if the market provides an opportunity near the 300 rupee zone, it could offer an even better risk-reward entry.